September 19th, 2023, and oh, what a day it was. MBS were down another 17 basis points on the open today. S&P futures dipped by 4.25 in the morning. In addition to the housing starts data, Canadian inflation came in a bit hotter than expected on the headline level at 8:30 a.m. Even before then, selling pressure on European bonds had been ramping up and stocks had been slumping. None of the individual data points line up with the bigger moments of volume and weakness, but the overall pattern fits one of two narratives, either pre-Fed anxiety or a pre-Fed move to get to the sidelines. Benchmark Brent crude oil topped $95 a barrel for the first time since November, adding to concerns about inflation. Crude has soared by about a third since mid-June as Saudi Arabia and Russia joined hands to curb supplies and drive a rebound in prices. Housing starts came in at 1.183 million on a 1.44 million forecast. These builders drive me nuts. Building permits came in at 1.543 million on a 1.43 million forecast. Building permits increased to 1.54 million, which was up 7% month over month, but is still down year over year. While single-family starts fell, the big story has been the collapse in multifamily, which has fallen off a cliff recently due to high rates and a glut of new supply already under construction. Shortages remain an issue with skilled construction laborers in short supply, along with buildable lots, transformers, and now insurance. Some good news on the inflation front, though, is single-family rent growth dropped to a 3-year low in July, rising only 3.1%. This is a return to pre-pandemic levels of growth, though it is going to make it hard for a lot of those people in the previous paragraph to cover the nut on their higher construction loans. The soft landing rhetoric is quickly being replaced by sticky inflation whispers. The question is now how long rates will stay elevated by the Fed to ensure it has won the inflation battle. Fed fund futures are pricing in 3 rate cuts by the end of next year, which is quite hopeful in the face of the sticky slog back to the Fed's 2% inflation target. Bonds began the day in moderately weaker territory, mostly following an overnight sell-off in Europe. Trading levels had recovered enough by 10 a.m. that we could consider an overall trend of mostly flat. In fact, MBS came fairly close to breaking even just before 2 p.m., but then things went sideways on us. Actually, sideways is the wrong word. Prices dropped somewhat abruptly and Treasury yields spiked to near super long-term highs. Without any clear scapegoats, we're forced to rely on explanations filed under the category of pre-Fed jitters. One would think traders already know how jittery they were before 2 p.m., but sometimes you don't know until it's time to make a decision. MBS closed the day down 25 basis points at 97.92, where you're in the middle of an ugly range, with the 50-day moving average of a ceiling at 98.114 and a floor at 98.839. If you still have a chance to, I'd lock anything up before the Fed tomorrow. I got a feeling it's going to be a hawkish hold.